Good morning, everybody. I don't think that I can't see y'all, but hopefully you can see me. Just not familiar with them. There is a view button top right-hand corner that will toggle between me being big or small and the whatever I'm sharing on my screen as being full screen or not. If you have any questions, you can type them into the chat box down at the bottom. We will get to those at the end of our webinar today, but I just want to welcome everybody. Looks like we've got most everybody here. Thanks for joining us. My name is David Jenkins. If I haven't met you before, I'm an advisor at Victory Financial. I've been here, I think this is my 7th year, just had a work anniversary. So thanks for joining us. I don't know if this is the first webinar you've caught of ours, but we've started these last year. We've been doing the monthly. There's a different topic each month. So I'm going to okay. Hopefully everybody can see my screen now. It should say key financial changes in 2021. Again, my name is David Jenkins. I'm an advisor here at Victory Financial. Like I said, we've been doing these webinars every month, and we thought to start the year off, it would be appropriate to review some of the key financial changes that will be affecting you in 2021. I'm going to start by wrapping up the wild year that was 2020 and doing a market review. We'll move on to some reviewing the key financial changes in 2021. And you should have received a key financial data PDF via email. So when we get to section 2, if you want to pull that out and have it handy, it'll make a lot of what I'm saying easier, especially if you're on a smaller screen like a phone or something that the numbers are kind of small, the font's small. Then I'll move on and discuss the recent legislative landscape, such as the Tax Cuts and Jobs Act of 2017, the Secure Act in December 2019, the CARES Act, and the most recent coronavirus relief bill signed into law at the end of last year. And then lastly, we'll do a look ahead at kind of what the new landscape is, the new environment, and what to expect moving forward for the rest of 2021. Again, if you're just joining us, on the top right hand, there's a button to toggle the screen view if you want to have me large or small, which I don't know why you would want to have me small. I'm so handsome. I'd have me up in the full screen, but that's just me. But also, if you have any questions, you can type them into the chat box, the Q&A box at the bottom, and then we will try to get to those at the end. All right. So the year 2020 proved to be one of the most tumultuous in modern history, marked by a number of developments that were historically unprecedented. You know, I think if you watch the news at all during 2020, unprecedented was the word that maybe the buzzword that got used too much. But the year also demonstrated the resilience of people, institutions, and financial markets. And you know, I know that 2020, for me at least, simultaneously seemed like the longest and shortest year that there's ever been. But on top of the health crisis, you might remember that there was also widespread civil unrest over the summer, tied to policing and racial justice, the Black Lives Matter movement. And then in August, Americans kind of shifted their focus towards the US presidential race that seemingly just wrapped up as Biden was sworn in on the 20th. But this is how it started. This is index returns from the first quarter of 2020. So this was January 1st to March 31st, 2020. The US stock market, as defined by the Russell 3000, so the 3,000 US companies, it ended the first quarter down 21%. International developed stocks were down 23%. Emerging markets were down 24%. Global real estate was down 29%. And bonds, the US bond market and the global bond market, they were up 3% and about 0.5%. Now, for the quarter, for these asset classes, that was the worst quarter for international developed stocks. But for the US market, emerging markets, and global real estate, their worst quarter was all the fourth quarter of 2008 during the financial crisis. Now, and this is how it ended. Somehow we got from all these red arrows to these green arrows and the one red arrow. But by the end of 2020, the US stock market was up 21%, international developed was up 7.5%, emerging markets stocks were up 18%, global real estate was still down 9%, and then the US bond market and the global bond market were also up. Now, this is, for the US market at least, it was above its historical average, which is kind of wild to think about considering how the year started with the coronavirus pandemic in late February and early March. And then for a more detailed look, it's probably a little bit small, but for sub-asset classes, the Russell 1000, which is US large stocks, it led the way with 21% positive return. The overall market as a whole, the Russell 3000 was next with just shy of that. And then following that was the Russell 2000, which is US small companies. And initially the recovery in US small cap stocks lagged behind that of large companies, but eventually the Russell 2000 caught up and ultimately outperformed the S&P 500 index, which is one most people are probably most familiar with. The S&P 500 had a 18.4% return for 2020. And so far, small companies in the US have continued to outperform in the new year. Emerging markets also performed well in 2020, matching the performance of S&P 500 almost exactly. They had 18.31%, whereas the S&P did 18.4%, which definitely outperformed international developed stocks, which returned 7.6% last year. But lower interest rates and a decline in the US dollar, which was down about 7%, was especially helpful to emerging markets economies, which tend to borrow in US dollar denominated debt. Okay, so this was what the world stock market looked like in 2020. And I don't know if y'all recall, but at the beginning of the year, on February 19th, the S&P 500 peaked. It set a record. So this COVID-19 pandemic really followed market highs. And you can see here that from February 19th to March 23rd, there was over a 30% decline, which was very, very quick, as you can tell by the steep curve. But then it bottomed out on March 23rd. And one thing to notice that market prices quickly reflect new information about the future. So one thing that the market doesn't like is uncertainty. And at the beginning of this coronavirus pandemic, we didn't know anything about it. It was new, and it seems like every day we were learning something new and awful about it. And so because markets are forward-looking, they very quickly, almost immediately, incorporated that into their prices. And so with some panic selling and everything, you saw that decline as the markets priced in a long economic recovery. But then as more information about the virus became known, and our knowledge just grew and grew almost exponentially as time went on, you can see that the market very quickly started to rebound, and then actually it had recovered all of its losses by about mid-August. I mean, it was definitely aided though by economic stimulus and banks, global banks, working to kind of prop up the prices. Okay, so some themes and lessons from 2020. Obviously, I guess number one should be toilet paper is the new currency, maybe followed by Clorox cleanup wipes after that. But in all seriousness, COVID-19, the average duration of a bear market correction is 22 months. The COVID-19 pullback only lasted 33 days, making it the sharpest and quickest decline to recovery on record. And as I said, even though they were down 35%, that they had largely recovered by mid-August. Growth versus value, growth stocks performed well during the pandemic, returning 31%. Market rotation from growth to value and cyclicals is underway as vaccine news get better in 2021. Volatility, the coronavirus played a huge role in the volatility of the market in 2020. The volatility index, the VIX, which measures volatility and general investor uncertainty, reached a reading of 66 on March 23rd, which the last time it was that high was when it was 77 during the financial crisis in 2008 and 2009. Unemployment, 2020 began with one of the lowest unemployment readings ever at 3.6%. As the pandemic hit, though, unemployment levels reached as high as 14.7% in April. And again, these levels were not seen since the Great Depression. And the vaccine, it usually takes years to develop a vaccine, but 2020 saw companies such as Pfizer, Moderna, and AstraZeneca race to develop a vaccine in record time. In less than half a year, phase 3 was reached by these companies with estimated 90% effectiveness, and the market obviously responded very favorably to these developments in Q4. Another big piece of news from 2020 were the presidential elections that are now behind us, and it created additional market instability. As I mentioned, the markets don't like uncertainty, but they've been responding well so far to President Biden, and we will discuss this in the last section today. Again, if you have any questions, feel free to type them into the Q&A chat box at the bottom, and we'll get to those at the end. Okay, so let's move on to key financial changes in 2021. I mentioned it before, but you should have received via email one of these key financial data quick reference cards. We want to be sure that you have it handy. It's just a good resource. I use it a lot. It's got it's got all the information in this following section on it, and I reference it almost on a daily basis. And then if you would like a hard copy, we have some of these with printed with on card stock at our office. So you could schedule a time to drop by and get one of those, or we could send you one if you would like. But I'm going to start on the front side of this, just with the federal marginal tax brackets. In 2021, we still have 7 brackets ranging from 0% to the top rate of 37%. These are still down from the prior 39.7% top rate due to the 2017 Tax Cuts and Jobs Act, which is set to sunset at the end of 2025, at which point we will probably revert to the prior rates, so 12 becomes 15, 22 becomes 25, and so on, and the top rate going from 37 to 39.6%, barring any preemptive legislation action before the end of 2025. The numbers here just changed slightly. The brackets, you got a little bit of an increase with all of them with inflation, but nothing really exciting to report there. Standard deductions and the child tax credit. Remember I'm going to call the Tax Cuts and Jobs Act, the TCJA, eliminated personal exemptions and tried to kind of simplify. They got rid of a lot of itemized deductions so that, and they increased the standard deduction to hopefully incentivize people to take the standard deduction instead. So if you're married, filing jointly, or qualifying widower, there's a $300 bump in that standard deduction to $25,100. Single or married filing separately got a $150 bump from $12,400 to $12,550, and there's a $150 bump with the head of household as well. Additionally, if you're blind or over age 65, you got a $50 bump. So that deduction went from $1,300 per person to $1,350 per person. And the same with blind or over 65, unmarried, not a surviving spouse, it got a $50 bump. For long-term capital gains, they largely stayed unchanged. It doesn't exactly line up with the 12% bracket. I think there's maybe a couple $100 difference either way, but a good rule of thumb is that if you are in the 12% federal income tax bracket or lower, you will not owe long-term capital gains taxes. Again, these are capital assets, so, and that includes stocks and bonds and mutual funds held in a taxable account that you have held for 1 year or longer. Remember that short-term capital gains, which is holding them for less than a year, they are taxed at whatever your ordinary income tax rate is. Once you move up into the 22% tax bracket, or once you move up into the next tax bracket, the long-term capital gain rate is 15%, which is still a discount from the 22% or higher rate that you're in. And then once you're in the highest tax bracket, the long-term capital gains rate goes to 20%, which is still much cheaper than it would be paying ordinary income taxes. For retirement plan contribution limits, these are employer-sponsored plans. No changes to 401ks, 403bs, the catch-up provision, simple plans. Those are all the same as they were last year. So as an employee with a 401k or 403b, you can defer up to $19,500 of your salary. If you're over age 50, you get a catch-up provision, which is an extra $6,500. So that would bring that total to $27,000 or $26,000, excuse me. Simple plans still $13,500, and then an additional $3,000 catch-up. The only changes were the annual compensation used to determine contribution for most plans. You get a $5,000 bump to $290,000, and then defined contribution plans basic limit, which is the amount that you as an employee and an employer can collectively combined contribute to your qualified account. That got a $1,000 bump. For IRAs, individual retirement accounts, Roth IRAs, traditional IRAs, no changes here. The annual limit is still $6,000 with a $1,000 catch-up provision. And again, this is earned income. So to be able to contribute to a IRA or Roth IRA, you have to have earned income. And there are some phase-out limits depending on if you're covered by a plan or your spouse is covered by a plan. The big one, though, is the income limits for contributions to a Roth IRA. And instead of taxable income, this is your modified adjusted gross income. So this is your AGI plus some of those above the line deductions added back in. So for a Roth IRA, if you're a married filing joint filer, once your MAGI gets to 198,000, that 6,000 limit, annual contribution limit, starts to decrease. And then at 208,000 of modified adjusted gross income, you can't contribute anything to a Roth. With single, the phase out starts at 125,000, and you're completely eliminated for eligibility at 140,000. But remember that there are opportunities if you're above these income levels to do a backdoor Roth IRA strategy, which if you have questions about that or want to talk to your advisor about that, by all means reach out, because that is something that is an opportunity to get money into a Roth. And then with a Roth conversion, there's no income limit on that. You can always do a Roth conversion. For health savings accounts or HSAs, the maximum deductible contribution went up by $50 for individuals to $3,600, and for families, you got an extra $100, so went from $7,100 to $7,200. health savings accounts offer that rare tax trifecta. You make a pre-tax contribution, you enjoy tax-free investment returns, and then as long as you spend the money on qualified medical expenses, the distributions are tax-free. So it's like combining a traditional IRA and the good pieces of a traditional IRA and the good pieces of a Roth IRA. The downside, though, because it's the only special account with all of these features, is that it's only available to those who are enrolled in a high deductible health plan, which the trade-off is that those pose steep upfront costs for consumers. So one of the requirements to be a high deductible health plan is the minimum annual deductible for individuals $1,400 and families is $2,800. Medicare premiums and IRMA. IRMA just stands for the income related monthly adjustment amount. So the base Part B premium for Medicare went up slightly. I think it went up about just shy of $4. I want to say it was $3.90, but went up. The Part B premium went up to $148.50. Married filing jointly, as long as you're again just as with the Roth income, it's using your modified adjusted gross income. As long as you are your MAGI is 176,000 or less, you don't have a income related monthly adjustment amount. So it will just be the 148.50. But then as your income moves up, they start adding to the premium. Remember that Medicare premiums are calculated using your income from 2 years prior. So decisions made today will have a future impact. Now, there are some exceptions that obviously if you are working and then you retire, your first year of Medicare is going to be based on 2 years earlier when you were working and presumably had a higher salary than you do now. But there is a form that you can fill out to try to get an exception. It's not guaranteed, but it does make qualifying life change exceptions for qualifying life events such as retirement. Social Security, the estimated maximum monthly benefit if turning full retirement age of 66 in 2021 is $3,148. The thing that I get a lot of questions about is the retirement earnings exempt amounts, or the retirement earnings test, which is $18,960 if you are under your full retirement age. So when Social Security beneficiaries earn money from working, they risk a temporary reduction in benefits if your earnings exceed a certain amount. So that's what these amounts are. If you're under your full retirement age, for every $2 that you earn above this $18,960, $1 is withheld from your Social Security benefit. In the year that you reach full retirement age, $1 benefit is withheld for every $3 of earnings above $50,250, which that is up from $48,600 previously. And once you reach your full retirement age, there is no retirement earnings test, so they don't penalize, they don't withhold any of your Social Security income once you are over your full retirement age. I believe these are unchanged. The tax on Social Security benefits, it's your provisional income, which is your income plus half of your Social Security income, and they add in some other things like interest and some other items to get your provisional income. But married filing jointly, if your provisional income is under $32,000, you do not owe you owe any taxes on your Social Security. At between $32,000 and $44,000, it kind of phases into up to 50% will be taxable, and then over $44,000, up to 85% of your Social Security benefit will be taxed. And the 2021 Social Security Cost of Living Adjustment, or COLA, is 1.3%, which is a slight decrease from the 1.6% COLA in 2020. I'm sure most of you that are on Social Security are aware that that usually just kind of goes to offset the increase in the Medicare premiums. Okay, so obviously there's a lot of numbers on that key financial data. Again, it's just a quick reference. I tried to pull the ones that I thought were most relevant for this year. So I will move on to discuss the legislative landscape. Again, that's the Tax Cuts and Jobs Act, Secure Act, CARES Act, and this latest relief bill. There's been three major pieces of tax legislation in 3 years. The Tax Cuts and Jobs Act of 2017, I've referenced several times, which is how we got the tax brackets and the standard deduction and stuff that we have now. As I mentioned before, most of those changes are temporary as they're due to sunset at the end of 2025. Notably, it cut the tax rate from top rate from 39.6 to 37%. It reduced the corporate tax rate from 35% to 21%. Like I mentioned, it reduced or eliminated a lot of the deductions, replacing them with a larger standard deduction, and it limited state and local tax deductions, or SALT, to let's see, the Secure Act. It was passed in December 2019. You know, if you met with us or spoke with us last year, I'm sure we mentioned this, but I feel like it kind of it really affects retirement planning and retirement accounts, and it may have gone under the radar just a little bit because of being overshadowed by coronavirus and an election year. But the Secure Act was passed in December 2019, contained several changes to retirement planning. I will discuss those in greater detail in a minute. And then lastly, in March, we had the Coronavirus Aid, Relief, and Economic Security, or CARES Act. It was a $2.2 trillion economic stimulus act, included a one-time cash payment to individual Americans. If you were eligible under the AGI limits, single adults received $1,200, and families with children could receive more, and increased unemployment benefits, and it created the Paycheck Protection Program, or PPP, loans that provide forgivable loans to small businesses. So the Secure Act, the RMD age, it moved from 70 and a half to age 72. So it provides you an extra 18 months before, while you can let your retirement funds grow before you're being forced to tap into them. And it also, one thing to note is that qualified charitable distributions, or QCDs, are still allowed at age 70 and a half. So if you're age 70 and a half, but not quite 72, and you want to make a QCD to a charity or church or civic group, any kind of nonprofit, you can do that and have it sent directly from your IRA, and you don't have to pay taxes on it, and it doesn't count as income. And then once you turn 72, you can also do that with your RMD. But I think this was kind of them legislators throwing nonprofits a bone, since a lot of the itemizing of deductions, they made that hurdle higher for people, so it hurt nonprofits. Investors are no longer prohibited from contributing to a traditional IRA if they are 70 and a half and older, as long as you have earned income. Now, so they got rid of the maximum contribution age. Previously, you can only contribute until age 70 and a half, at which point you would be forced to start withdrawing from the account. But I think they realize as more people continue to work past age 70 and lifespans increase, it makes sense that people want to contribute to retirement accounts for a longer period of time. There are no age-based restrictions to contributing to a Roth IRA. Again, you just have to fall within the income limits and have earned income. And it most notably eliminated the stretch IRA for non-spousal beneficiaries. Instead of stretching required minimum distributions over the beneficiary's lifetime, non-spousal beneficiaries must now liquidate the entire account within 10 years of the death of the original owner. I will discuss that a little bit more now. There are some exceptions. The IRS calls eligible designated beneficiaries, which includes surviving spouses, disabled or chronically ill beneficiaries, those who are not more than 10 years younger than the original owner, and minor children. In that case, in the last case for minor children, the 10-year clock starts when they reach the age of majority and doesn't include grandchildren or other relatives of the original owner. So if your beneficiary is a minor, once in the age of majority in Georgia, I believe is 21. So once they reach age 21, that's when the 10-year clock starts. So they would have until their 31st birthday to liquidate the IRA. And again, this only applies to accounts inherited in 2020 or later. So if the original owner passed away after December 31st, 2019, so January 1st, 2020, this will apply. The CARES Act, March 2020, what's still relevant for 2021? Well, the big thing is that RMDs are back for 2021. While it suspended them for 2020, required minimum distributions are again required for 2021. And you know, the CARES Act went so far as to even allow you to reverse an RMD taken earlier in the year. If you returned your RMD to the distributing account by August 31st, the RMD is instead treated as a 60-day rollover, regardless if it was returned within the 60 days, and only amounts up to the RMD could have been returned. But the distribution and reversal of the RMD is treated as two transactions to the IRS. The first is a distribution and then a subsequent rollover. As such, even if you returned your RMD for 2020, you will still receive a 1099-R from your custodian. Consult with a tax professional, but correctly reporting this transaction does fall on you as the taxpayer when you file your 2020 taxes. The amount of the distribution on the 1099 should be noted on line 4A of your 1040, but line 4B, which is the taxable amount, should be equal to $0 and marked as a rollover. In May, after most people have filed their tax returns, your custodian will send you an IRS Form 5498, which indicates the amount of the rollover to your IRA. Coronavirus-related IRA or 401k distributions from 2020 can be spread out over 3 years. One thing that they realized a lot of people were out of work. The CARES Act waived the 10% early withdrawal penalty for distributions up to $100,000 from qualifying or from eligible IRAs and qualified accounts such as a 401k or 403b prior to age 59 and a half. Again, so it's if you're under age 59 and a half, there's a 10% early withdrawal penalty. A qualifying coronavirus-related distribution applies to those individuals who were diagnosed with COVID-19, whose spouse or dependent was diagnosed, or experienced adverse consequences from being quarantined, furloughed, had an inability to work for lack of childcare, or saw a reduction in hours because of the pandemic. So generally, when you pull money out of a IRA or 401k, any kind of qualified account, they're usually included in income in the year that you pull it out. So if you pulled out $100,000 in 2020, that would add $100,000 to your taxable income for 2020, and you know taxes on that. But they are letting you spread this out, the tax burden, over 3 tax years. So they do it ratably over a 3-year period, starting with the year in which you receive your distribution. So for example, if you received a $9,000 coronavirus-related distribution in 2020, you would report $3,000 in income on your federal taxes for 2020, 2021, and 2022. However, you can also elect, you have the option to have the entire distribution included on your income during 2020. You also have the option to repay the coronavirus-related distribution within 3 years and then file amended returns for any affected prior tax returns, and you can be able to get a refund of any income taxes paid. And you can do this in installments or a one-time lump sum. The CARES Act, so obviously 2020 has passed, but don't forget, if you did this, there's a $300 above the line charitable deduction. So this, even if you don't itemize, you can deduct up to $300 for a charitable contribution in 2020. And then lastly, just Rob Fazekas, one of the advisors at our firm, provided this tidbit, but at a price tag of 2.2 trillion, this was the equivalent to about 9% of the United States gross domestic product, or GDP. By comparison, the stimulus packages passed in 2008 and 2009 amounted to about 4.5% of GDP. Lastly, we have the new 900 billion coronavirus relief package. Came in at 5,593 pages and is part of the Consolidated Appropriations Act of 2021. So it was attached to the spending bill that will fund the government through September. The law includes $600 for individuals making up to $75,000 in adjusted gross income and $1,200 for married couples making up to $150,000 in adjusted gross income, as well as $600 for each dependent child. They changed it a little bit. So what qualifies as a dependent child, and also just because your adjusted gross income is above $115,000, it doesn't automatically eliminate you from getting the stimulus checks. So if you have children, depending on the number of children, and if you want to contact us, we can help you with the calculation for this, but you still might be due some of the stimulus check. And this is a refundable tax credit based off of your 2019 AGI. And starting December 27th, they extended unemployment benefits. So they'll receive an additional $300 a week in federal benefits for an additional 11 weeks through March. Additional relief is added $325 billion for small businesses, which was $280 billion for PPP loans, $55 billion for vaccines, testing and tracing, $82 billion for schools, and $45 billion for transportation. The package does not include funding for state and local governments, which was Democrats' priority, and it neither included a liability shield for businesses, which was the Republican priority. It passed overwhelmingly by a vote of 359 to 53 in the House and 92 to 6 in the Senate. So if you are due a stimulus check, you probably should have already received it. If obviously your 20, if your adjusted gross income changes, you might be able to get some of that back as a refundable tax credit. And I don't think it's on here, but it also featured above the line $300 charitable donation deduction. It extended that for 2021, but it also, instead of $300 per tax return, it's now $300 per tax filer. So if you're a married couple filing jointly, you can actually have a $600 above the line charitable deduction, but it must go directly to a 501c3 nonprofit organization, so it's not the same as using a donor advised fund. And the AGI limit for qualified charitable cash donations was raised to 100% for 2021, and the AGI floor for deducting out-of-pocket medical expenses has been lowered to 7.5% permanently. Okay, so I know that it's been us, especially us lucky Georgians, that got, I feel like I probably got 100 pounds in full page, double-sided printed political mailers, but the election and what's to come has obviously been on top of mind for a lot of people. So let's look ahead at the new administration and what to expect for the rest of 2021. Firstly, though, the economic recovery begins and ends with COVID. You know, a lot of top economists and banks and the Federal Reserve Chair, they've all said it, that to get everything back on track, you have to tackle COVID first. So The launch and distribution of an effective vaccine and other progress against COVID-19 is likely the most direct path to improved economic growth. And I know that talking to some of my clients and family members and family friends, that y'all are starting to get the vaccine, and so it looks like that they are ramping up distribution. So hopefully more people will start to get that quicker. Biden's will first focus his energies on additional stimulus and COVID relief. He unveiled his 1.9 trillion stimulus and vaccine distribution plan titled the American Rescue Plan on January 14th. His American Rescue Plan would include a third round of direct payments of $1,400 sent to most Americans, which coupled with the $600 from December, it brings the total delivered in the second round of checks to $2,000. So if you recall, the House Democrats, Nancy Pelosi was championing $2,000, and so was then President Trump. And it also extends federal unemployment insurance through September, increases them to $400 a week, and raises the federal minimum wage to $15 an hour. So, this is some key elements from Biden's tax plan, some of it from his campaign and some of it from some policies and proposals he's released since then. But one of his top ones is a return to the 39.6 tax rate on incomes over $400,000, an increase in the corporate income tax rate from the current 21%. I know that 28%, I believe, has been thrown out, and 25%, but it would still be well below the 35% corporate tax rate from before the Tax Cuts and Jobs Act. And he's also floated a possible minimum corporate tax rate of 15%. Decreasing the estate tax exemption to the 3.5 million or 5 million plus inflation level from today's 11.58 million. So right now the estate tax exemption was essentially doubled. This is still per person though, and potentially eliminate the step up in basis for inherited capital assets above some presumably large exemption amount. So again, this would affect the next generation or your heirs. So this is, when we talk about the cost basis and taxable brokerage accounts and stocks and mutual funds, when you die and whoever inherits an account or assets from that type of account, they get a step up in cost basis. So whatever the fair market value was on the date of your death would be their new cost basis. Also talked about removal of the state and local tax or SALT deduction cap, which is set at $10,000 for single taxpayers, with married couples filing jointly, and then $5,000 for married taxpayers filing separately. And then he's also discussed eliminating the 401k tax deduction in favor of a tax credit, which would benefit lower earners more. So, right now with a deduction, if you are in the 37% tax bracket and you put in $10,000 to a 401k or some sort of pre-tax account, you're presumably saving $3,700 in tax on that. Whereas if you're in a much lower tax bracket, obviously, you're in the 10% tax bracket, you're not saving as much, you're only saving 10%, but a tax credit would benefit lower earners more. And so if you haven't noticed, most of the Biden tax plan is aimed at those higher earners. So, I believe it's what he describes as people making over $400,000 a year in taxable income. So for much of the United States, the majority of the middle class, upper middle class, and definitely the lower class, this would not affect them as much. There are hurdles to overcome in Biden's tax proposals. With a weak economy and energized political opposition, it's going to limit the opportunity to raise taxes by Joe Biden administration. In an economy struggling with growth and high unemployment, generating jobs will take precedence over additional revenue. And the light blue wave left Democrats with very slim margins, notably a 50-50 split in the Senate with the vice president serving as the tiebreaker. But you also have moderate Democrats such as Senator Joe Manchin, a Democrat from West Virginia, which will likely be hurdles to implementing some of Biden's more progressive policies. But don't let politics rule your portfolio. There's danger in trying to adjust your portfolio to election results. As the news changes, markets will react quickly to new information. The day after the election, growth stocks soared, small caps were flat, and interest rates dropped. History shows that market returns are not as president or party dependent as many think. In fact, the biggest impact on stock markets is not the president or the party in control. Instead, it is the economy, interest rates, and federal policy. So does party control matter? Historical returns say no. Based on data beginning in 1949, during periods when Republicans controlled at least two of the three, which is the presidency, the Senate, and the House of Representatives, the S&P rose 14.8% per year. And when Democrats held at least two of the three, the S&P 500 rose almost 12% per year. So the stock market rose significantly in both of those scenarios. And both Democratic and Republican one-party control outperformed a divided government. And Democratic presidents averaged a higher rate of return than Republican presidents. But I know, especially this go around, politics seem to be a little bit more emotional than they normally are. And so it drove a lot of news. And it didn't seem to have a dramatic effect on the markets, though. So this is probably a little hard to see. The blue lines are Democratic, the red lines are Republican, and the purple lines are when it was mixed. As you can see, from 1949 to present, one party had a 15% annual return, whereas divided government had an 11.5% S&P 500 return. So, some final thoughts and key takeaways. More coronavirus economic stimulus is expected during Q1 of 2021. Biden unveiled his American Rescue Plan, but there's already been some opposition to that. Joe Manchin, of the Democratic senator from West Virginia, has already opposed a couple lines in that plan. But I would expect that's priority one. Probably more stimulus is coming by the end of the first quarter. Will taxes go up in the future? Likely yes, but not as much as previously predicted because controlling margins are slim. And again, like I said earlier, Biden's tax policies are targeted to those making more than $400,000 per year. Markets like a Goldilocks government. So again, this has to do with Democratic control of the Senate coupled with their razor-thin majority. It creates a government that can get the good things done. So for instance, that would be another $1 billion stimulus program, infrastructure spending, et cetera, but without being able to do the quote bad things, which are huge tax increases, a new green legislation, and other progressive bills. It's called a Goldilocks government because the market's like not too hot, not too cold. As a result, the Dow Jones and the Russell 2000 broke records on Wednesday, January 6th, once the Georgia runoff winners were declared. More potential deficit spending will weaken the dollar, the US dollar, making international investments more attractive. The dollar is likely to continue devaluing due to rising taxes, rising deficits and debts. The light blue wave paves the way for more potential deficit spending to combat COVID-19 and implement some of Biden's priorities, such as rebuilding infrastructure. A lot of people have speculated that infrastructure plan will be the second half of 2021. And additionally, the possibility of easing trade tensions could put incremental downward pressure on the dollar. A weaker dollar makes international investments more attractive, especially in domestic companies with an international presence, commodity exporting in emerging market countries. And interest rates will likely remain low, so refinancing your mortgage is still an attractive option if you haven't done so yet. The Federal Reserve, led by Chairman Jerome Powell, has signaled that this rate will remain at 0 until their inflation rate is at 2% and full employment is reached. But a lower interest rate allows corporations to borrow cheaply and incentivizes investment, which helps fuel the stock markets and other riskier asset classes. But the Fed is clearly focused on sending a strong message to individuals and corporations alike that they're here to ensure that the economy returns to and remains in a place of strength, and it isn't afraid to take drastic measures to make that happen. The CARES Act and a lot of these stimulus packages and how immediately they went to 0% interest rates, I think, are proof of that. And they even made the unprecedented move of starting to buy some corporate bonds this past year, because the response to the 2007 and 2008 financial crisis was criticized as being too little, too late, and clearly that left an impression on them. So the Fed's determined to provide as much support as needed to keep the market strong, and one way to do that is keeping a low interest rate. Any questions?
Hey, David. So
Hey.
we do have some questions from some of our attendees. One question is, how do you and the other wealth advisors work with accountants and CPAs at tax time to make sure that they're maximizing all of these different things?
So, if you've given us permission to consult with your CPA or whoever prepares your taxes, we can send over those documents to them, and if they request anything for us about specific trades or anything like that, we can help get them the information they need and make sure that they have all the information they need to properly prepare your taxes. I know me personally in the past have gone with my clients to kind of sit in on a meeting with their CPA, just to, sometimes you don't know the right questions to ask, and I feel like as advisors we do know a lot about our clients, and so sometimes I can help facilitate and make sure you're asking the right questions and getting the actual answers that you're trying to get.
Very good. One attendee would like you to explain step up in inherited capital gains.
Okay, so with taxable assets, so it's like a taxable brokerage account, or something like a house. If you want to get really simple and granular with it, like I guess a baseball card or some kind of art collectible counts. But you have a cost basis, which is what you paid for it. So I'm just going to use, let's say you bought a stock at $5 per share 40 years ago, and maybe that $5 per share stock was Apple, and you held on to it all this time, and throughout time now it's worth $100 a share, but you're still holding on to it. So your cost basis is the $5. If you were to sell it, you would pay taxes on the realized gain, which would be the $95 in growth, the difference between its current market value and what you paid for it. And this is where short-term and long-term capital gains come into play. If you hold it for less than a year, it's a short-term capital gain taxed at your ordinary income tax rate. If you hold it for longer than a year, you get that long-term capital gains tax rate. Now, if you, as it stands currently, before anything happens, if you give that stock that you paid $5 for to someone to your children, while you're still alive, if you give it to them while you're still alive, you're also gifting them your cost basis. So now they own the stock, their cost basis is $5. If they sell it, they're going to pay capital gains on the $95 of growth. But the step up is when you pass away and they inherit it. So you leave it to them when you die, and they get a step up in basis. So they inherit it, and the fair market value of that stock on the day that you died was $100. Instead of that $5 cost basis, their cost basis is stepped up to the new $100 cost basis. So the idea there is that they could immediately sell it if they wanted to and realize none or very minimal capital gains.
Okay, that was very good. Thank you. And then somebody asked, can I do that QCD thing from my 401k?
I am not sure. It might be, one of those things where, with a lot of 401k providers and everything, they operate under the structure and the framework of the IRS that they've been given, but they do have a lot of rules and kind of things that they just have on a personal level with each of the plans. So I don't know the answer to that, but we can definitely find out. And oh, Chuck says QC only from the IRA, so that answers that.
Very good. Those are all of our questions that have been submitted. If anybody else has a question, feel free to type it in the Q&A or the chat box. And in the meantime, I wanted to let you know we're going to send a link to this online. So if there's anything you'd like to review again, you'll be able to watch it back. And then the key financial data card that David mentioned, we have hard copies of that at our office. If you would like us to mail you a copy or stop by, just email me. It's marketing@vickeryfinancial.com. My name's Betsy. And then also we're going to be replaying a live webinar at 6:00 tonight on the same topic. David's going to present it again. So you're welcome to tell your friends or family about it and sign them up. And then we also have at 4:00, there's going to be through Buckingham Strategic Partners, there's going to be a webinar about the post-inaugural look at any changes due to the Biden administration that might be affecting taxes. I know David covered much of that today. But if you're interested in even more information, send me an email, again, marketing@vickeryfinancial.com, and I'll make sure you get a link to that webinar too.
And lastly, like I mentioned at the beginning, we're doing these webinars monthly. The next one in February is on financial fitness presented by our advisor, Clark Holt. So Tuesday, February 23rd at 10 a.m. or 6 p.m. And you can register at vickeryfinancial.com/webinars, or if you just go to vickeryfinancial.com, on the top, kind of in the center of your screen, there's a link for all of our webinars scheduled for the rest of the year.
Thank you so much, David. I learned a lot.
Good.